I tell my students at Sciences Po, you want to study climate change? Great. But at the end of the day, this is a capital markets activation challenge, right? So I did a simple calculation. I said, okay, for last year, or for, I think this is for 2012, how much money does the market move towards low efficient, high carbon emitting assets? And how much does the market move towards highly efficient, low carbon emitting assets? And my definition for highly efficient, low carbon emitting assets are any technologies that put us on a scale and time scale relevant to the 2 degrees centigrade target, which is the target that governments have agreed to. Now, people like Jim Hansen in the United States are saying, no, 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 it's not 450 ppm and 2 degrees, it's 350 ppm and 1 degree, and you know that we're at 400 ppm, so it means going backwards, which is another number that I calculated. The cost, and maybe Ian might like this number, the cost of reducing a single ppm is 1 trillion US. So we're at 400 ppm. If we decide that the target has to be 350, by the time we make that decision, we'll probably be at 420, right? That's $70 trillion going to go backwards, okay? So our 23+ year approach has been, well, how do we shift this balance, right? This is, at the end of the day, this is what climate change is about, shifting the finance equation, right? Well, we tried this, right? We tried it by putting a price on carbon through the UN negotiation, through the EU ETS in California and Australia, right? And make that inefficient, high carbon emitting stuff, make it more expensive by putting a carbon price on it, and the market will then naturally will chase the more efficient, low carbon emitting stuff, right? Hasn't worked out for us, right? As I showed you on that slide, where our actual emissions are tracking higher than model emissions. So that's not going to, that doesn't seem to be happening on a scale meaningful to the problem. Now, I'm going to talk about this a little bit more, green bonds and climate bonds. I'm currently chairing the working group for the Climate Bonds Initiative in London. This is the fastest growing new debt asset class in history, these bonds. And it's the one bright spot. When people ask me, you've been watching this climate change experiment for 33 years now, are there any bright spots? This is a bright spot, and I'll talk about it more in a second. Okay, now, you said, all right, Moltor, you're talking about $2 trillion out of a global economy of 60. Okay, not a huge number relative to the size of the economy, but still, where's the money going to come from? All right. So, well, our plan A was put a price on carbon, and then the market will respond to that and shift carbon, but shift capital. But that didn't work. So the next answer is recognize. Plan B is recognize fundamental trends in the market and leverage them. Right? Okay. Institutional investors, pension funds, insurance, reinsurance, these companies, they control $83 trillion. Those AUM, assets under management. Right? So your super is part of that. Right? It's the biggest pool of capital on the planet. Right? You want to do something interesting with money? Talk to these guys. If you can convince them, you've got something going. Okay? They've got a problem. Right? Their liabilities are increasing at the same time that the normal stuff they invest in is decreasing. Why is this stuff decreasing? Well, the last financial crisis, governments created new capital requirements on commercial banks. These are known as Basel II and Basel III. As a result of these new capital requirements, I mean, banks could leverage themselves. You know, when the Fed went into Bear Stearns and into, who's the other big firm that keeled over there? Lehman Brothers, right? These guys were leveraged 80 to 1, right? Could you imagine you went to your bank and you said, you know, I've got $1,000 in my bank account, loan me $86,000, right? So they've changed the leverage ratios, and as a result, right, commercial banks are completely have to get out of this space. So as a result, the amount of capital and the deals, right, and the stuff that these guys normally love to buy are decreasing. Right. So their need for greater returns is high. Pension funds, I mentioned earlier, we're moving the largest number of people in history into retirement, right? So pension funds today, except for countries like Australia that have mandatory contributions, they're sweating it because their liabilities, they're about to see the largest number of people enter retirement, and the amount of money they're going to need to have on hand is so large that they're going to need to get higher returns, okay? So currently, if you look at a super or you look at a pension fund like Storebrand in Norway, these guys typically only have about 1% of their portfolio invested in infrastructure. Why? Because that's not what they like to play in, right? They like to play in stable, medium risk, low risk, nice steady cash flows, those types of things, right? And even less in green infrastructure. The climate bonds, green bond space is exploding because this investment trend towards green infrastructure is inevitable, right? These guys are moving into this space not because they woke up one day and said, oh my God, I'm green, I'm looking for green stuff. The normal stuff that they're buying is disappearing, right? And these things look like the stuff that they used to buy. But I'll talk more about that in a second. Okay. So I said this is the one bright spot. I got a chance to brief Connie Hedegaard. She's the EU Climate Action Commissioner in Paris about 2 months ago on this thesis about decarbonizing for growth. And she said to me, Michael, what are the bright spots? As policymakers, what do we need to do? I said, this is the most interesting thing I've seen, and the only thing I've seen that's happened in the 33 years I've been in this game that's happening on a scale, could happen on a scale meaningful to the problem, right? So ESG, or environmental, social, and governance, or SRI investing, has concentrated historically on equities, right? So if you wanted a green fund or a socially responsible fund, right, a fund manager would go out and create a screen, and they would invest in companies, tobacco, arms, gambling, right? And they had ethical funds, right? But your money went to buy equities, right? You bought shares, you put money into a fund, and that fund invested in equities. That market's been around for 25, 30 years. It's a small part of the total asset under management, but it's not insignificant. We've never had the equivalent on the debt side of the market. The result of the last financial crisis is we went from a world before the crisis dominated by equities, with bonds being second best, so now the bond market is significantly larger than the equities market, right? So bonds, the debt side of the equation, is the big side of town now. Okay, so and it's worth $100 trillion. Again, the kind of number that gets you up in the morning and wants you to go to work. New bonds. Okay, these bonds were launched by the World Bank and by the IFC and by the European Investment Bank in 2008, right? So these guys, they're AAA rated. Right? These institutions are AAA rating. And they use their AAA rating, their highest credit rating, right, to raise money. And because they have a AAA rating, institutional investors love to invest in things that they put out. So they issue debt. So the World Bank issues a green bond, and it uses 100% of the proceeds for wastewater treatment plants, solar PV, all these things in the space that I was talking about before. Right? And who's buying it? Pension funds, large institutional investors. Why? Because it has, not because it's green, because it has the right risk-adjusted returns, right? These guys, they chase risk-adjusted returns, and these bonds look really good from that perspective. All right, so last year, the total issuances of both by development banks and by corporates was about 12 billion, right? We did the same amount in the first quarter of this year, and Bank of America Merrill Lynch estimates by 2016 the market will be 400 billion. Now we're starting to get close to that trillion, 2 trillion number quickly, right? But here's the interesting thing. There's no premium yet on the green or climate credentials. That is, these institutional investors are buying these bonds because they look like the things they used to buy, right? Same risk-adjusted returns. What happens when the market assigns some kind of premium, either through regulation or by the market identifying these risks? If that premium were just tiny, and Connie Hedegaard asked me, give me an idea, I said, make them tax-free in Europe. Make the income from them tax-free in Europe, right? Municipal bonds in the United States, the income is tax-free. Now, of course, the market corrects the coupon or the payment based on the fact that they're tax-free, but still, you tweak them just a little bit, and instead of 400 billion in 2016, we're rapidly approaching $1 trillion, possibly, right? But at some point, the market's going to recognize these risks, and these bonds are going to have an added premium associated to them. When that happens, game over.